Hi you guys, it's Progressive Sisters Magic and we are back for lesson 8 part 2. Okay guys, so the last lesson we went over SMA and EMA for our indicators. Now we're going to go over oscillators, which we're going to go over RSI, relative strength index. Okay, now this is a great tool to use for trading. This combined with your indicators, with your SMA and EMA, chef's kiss. Okay, chef's kiss. So we're gonna go ahead and hop into that right now. So first we're gonna start off with a definition of a relative strength index, which is known as RSI, and we're gonna take that straight from the PDF file that we have. RSI is a momentum oscillator that measures the speed and strength of price movements. It ranges from 0 to 100. Over 70 equals overbought, price may pull back. Below 30 equals oversold, price may bounce. RSI is especially useful when combined with market structure and support/resistance levels. Now, RSI is going to be extremely useful when it comes to a volatile market. So when you're crypto and you have a very volatile market, which means very sudden price movements that are jumping everywhere, this RSI indicator or oscillator is going to be your best friend. So the reason why this is going to be your best friend is because it's tracking momentum, okay? It's tracking the speed and the change of price movements during the market, okay? During the specific day of the market, specific time of the market, it's tracking those movements. And when you're in an extremely volatile type of market conditions, you're going to want to know which direction you think that the market is going. What are these numbers in these price changes? What are they like leaning more towards, okay? So these oscillators for this RSI can be used to track divergences, can be used to track which way a trend is going to go, if it's going to have a reversal or something like that, and it can be used for support and resistance levels as well. But one of the most important reasons why people use this RSI, which is like why people use indicators in the first place, to be honest, is to be able to have a concrete exit or entry point, okay? So that means either when you're going to get into the market or when you're trying to get out of the market, when you're trying to get into a trade or when you're trying to get out of a trade, okay? So in a highly volatile market, you want to plan it out really good, because you can either make a lot of money or you can lose a lot of money, okay? We only want to make a lot of money, all right? So we're going to try our best to use our indicators and our oscillators to our advantage to make sure that we come out on top. So remember, like I said before in the beginning, that this RSI, it has a level of 0 to 100, okay? So a scale of 0 to 100. Now, when this RSI is larger than 70, so anything above 70, it's going to be pushing more towards that the market is overbought, okay? So that means that they're going to be expecting a price correction or a reversal, okay? Expecting the price to go down, all right? So that is signaling a bearish market. Now, on the flip side, when RSI is below 30, it's like, okay, there needs to be a price correction coming like soon to help bounce this price back up to like normal or decent levels, okay? So that means it's like leaning more towards a bullish type of market, meaning that it's an undervalued market that's about to gain its value back again, essentially. So you also have what they call a neutral zone, okay? And so that's when the RSI is going to be around that 50 level, okay? So when it's at 50, that means that there's a pretty good balance between the buying and the selling pressure. No one is really overlapping or overstepping the other, okay? Now, when it goes above that 50, like RSI goes above 50, that means that it's signaling a bullish market. Okay, when it goes that below 50, that means that it's signaling more of a bearish market. Now let's talk about how traders use this RSI to their advantage when they're trading. Overbought/oversold zones. RSI is greater than 70, an asset is overbought. Buyers might slow down. When RSI is less than 30, asset is oversold. Sellers might be exhausted. Trend confirmation. RSI staying above 50 is bullish. RSI staying below 50 is bearish. Divergence. When price makes a new high but RSI does not, it's a weak trend, possible reversal. When price makes a new low but RSI does not, buyers may step in. Example. Ethereum goes from 1800 to 2200 quickly. RSI hits 82, suggests that the rally might cool down. Later, Ethereum drops to 2000, while RSI drops below 40. The bearish momentum is confirmed. So now we're getting into divergence, okay? So essentially what that's going to mean is when the price of the crypto asset is going to be moving away from the RSI, okay, in the opposite direction. That is going to signal a reversal or a trend switch. It's basically suggesting that the current trend is weakening and that it's about to change directions, which is why it's called like a divergence. It's diverging from what it previously was. So in one of our very early on lessons, we went over what they call candlesticks, okay? And those candlesticks are literally price action for whatever time frame you have it on. So if you're on a 15-minute time frame, each candlestick on that 15-minute time frame is representative of the price action within that 15 minutes, okay? For that 15 minutes. No matter if it's 1 day, 1 week, 1 month, that candlestick is going to represent whatever time frame you're on. So when you have those time frames, those candlesticks, paired with, so market structure, paired with your support and your resistance levels, paired with this RSI, which is telling you basically like, okay, the price is going up, but the RSI is not changing. The price is going down, but the RSI is not changing. All that together will help you to get the most amazing entry and exit points, okay? Most amazing, because you have so much information to go off of, especially if you're understanding each aspect of it all, okay? And if you want to, you can pair it with the SMA and with the EMA, all right? But this RSI is like really powerful by itself, really like one of the most powerful ones in my opinion, because it's, if you're in a volatile market, you really want to have a clear understanding of what's happening next, okay? You don't want to just go in blindly, all right? SMA and EMA are more so for a bit longer, less volatile markets. Well, it still can work for volatile markets as well, but I really think that RSI is more practical for a volatile market because it's measuring the speed and the momentum of the price changes, okay? And if the price is continuously changing, you need to know at what speed and at what momentum it's going to change at, right? Now, I gave you a bit of an overview of what a divergence is, but now I'm going to give you like the textbook type of definition of what a divergence is according to our PDF file that we have. An RSI divergence occurs when the indicator and price begin to reach different levels, indicating a change in momentum that precedes a change in price direction. For example, a bullish divergence occurs when the security makes a lower low, but the indicator forms a higher low. This indicates rising bullish momentum and can be used to trigger a new long position. A bearish divergence occurs when price makes a higher high, but the RSI makes a lower high. This indicates a possible shift to the downside momentum. Okay, first let's go over a bullish example of a divergence. So that's when the price reaches a lower low, but the RSI reaches a higher low. So you remember on the charts when we have higher highs and higher lows, and lower highs and lower lows. Now you have basically the opposite with this one. You're going to have a lower low for the price, but a higher low for the RSI. So that is signaling that even though the price is dropping, the RSI is not dropping, it's going up. So it's signaling that the momentum behind this drop is about to like weaken, or it's already weakening, okay, and it's about to have a reversal. All right, so that is a great time for our buyers to step in, and that is going to be giving you a bit of a bullish type of signal. It's signaling a bullish trend is about to begin, or that it's already beginning and that the current trend is dwindling down. And another way you can see this is that sellers are losing their power, okay? They're losing their momentum, and there's about to be a rally, okay? So a rally is essentially when sellers are like out of the market and buyers are in the market, okay? So despite the price of the crypto that you're trading going down, if that RSI is going up, you can expect for a bullish type of market, okay? For the buyers to step in with a bang and the sellers be kind of just like, ah, okay? Literally, go sit down, sellers. The buyers are in charge of the market now. So the reason why a bullish divergence is really important when you're trading, when you're trying to plot your entry and your exit levels, is because you never want to sell at the bottom, okay? So imagine you see like a price of your crypto coin and you're like, okay, I want to sell right here. You guys, if you use this indicator and the price shows you that it's going to go up, just hold out, and then sell it at the top. All right, so the famous saying in any type of trading that you do, no matter if it be crypto, stocks, commodities, currencies, whatever, is buy low and sell high. If you're selling at the bottom, you just miss out on all the profits that could have came if you would have sold it at the high. Now, to be able to identify that high and know that you're not selling at the bottom, RSI is a very great tool to use. Now let's move into a bearish divergence, which is going to be the complete opposite of a bullish divergence. So that is going to be when the price is going to be moving up, so for a higher high, but the RSI is moving down for a lower low. So now let's move into what we call the bearish divergence. Bearish divergence is going to be the complete opposite of a bullish divergence. So that's when the price of the crypto is going to be going up for a higher high, but the RSI is going to be going down for a lower high. So this is basically signaling that the upward momentum is coming to an end. It's waning off, okay? And you're going to have a bit of some downward pressure that's coming in to make a price correction. So that means you're going to have a reversal to the downside, which is why it's called a bearish divergence. So you're going to see a bearish divergence on an uptrend, okay? So as the price is going up, that is when you're going to see that bearish divergence, okay? Same thing with a bullish divergence. When the price is going down, like a price trend is going down, that's when you're going to see the divergence of it being bullish. So when you have these divergences, whether it be a bullish or a bearish divergence, you have to really look at those support and those resistance levels, okay? That is going to really help you with your entry and your exit points. The resistance levels, the SMA, the EMA can be also used as well. The market structure, okay, and the trend lines are going to be really, really nice to use with this RSI. Remember, when you have indicators and oscillators, yeah, you can use just one, but all of them in conjunction with each other, or at least like a couple within conjunction with each other, plus market structure and things like that, is really going to make like a great trading strategy. All right. So when you're trading strategy, remember, we don't want to just trade news. We want to trade the charts. So you hear the news, you understand the news, but now let's look at the charts and what are the charts telling us? Because the news could be telling us one thing and the charts be telling us a completely different thing. Now we trade off of charts. We make money off of charts. So you have to understand what the charts are saying at all times, okay? And these indicators are going to help you understand the story that the price movements are trying to tell you. So now that's going to be it for lesson 8, part 2, and we're going to have one more part to this lesson, part 3, which is going to be the moving average convergence divergence, okay, you guys? Now, that's going to be known as the MACD. Using MACD in conjunction with the RSI is really going to be like, again, chef's kiss, okay? It's going to be a powerful tool, powerful indicator that you can use for your charts to be able to have a proper entry and a proper exit, okay? Now, the reason why I split this into 3 is because I want you guys to be able to understand each indicator by itself without me making a whole video cramming them all together. If you want to just understand one indicator because you understand the rest of the indicators, you can really just focus on the one video that you need, whether that be RSI, SMA, EMA, MACD, okay, and all the other things that we're going to be mentioning in this lesson, okay? So again, we have just one more part left in this lesson. So go ahead and go to our next lesson, which is going to be covering MACD plus RSI. So you already learned about RSI, then we're going to bring another one into the mix, okay, you guys? Now, practice on your charts, you guys. Please download TradingView, mark up your charts, use those indicators and those oscillators, okay? All of that is going to be on there. Open a brokerage account for free. Practice on your demo accounts. So while you're learning, you can also be implementing everything that you're learning, okay? So on that note, that is it for this lesson. And our next lesson is going to be covering MACD again. So let's go ahead and hop into lesson 8, part 3.